Hello, my name is Brian Overby. I'm known as the Options Guy, and I am the author of the Options Playbook. Welcome to Options Guy TV. We had, once again, an extremely busy week as far as earnings are concerned. Today, we're going to actually look at all the paper trades that we talked about this week. We had a little bit of a fun competition that we looked to do between Apple and Amazon. And I do appreciate the people that ran over to my Twitter account and actually participated in my reindeer game, where I asked you which underlying stock do you think you would like will outperform after earnings. And both Amazon and Apple announced after the close last night. And you guys got it right. Amazon is outperforming Apple right now. Apple's down a little bit, not even the expected move, over down around 4 or 5 points. And Amazon opened up almost right on the number of the expected move. So very close to that. So we're going to look at that fun little butterfly competition that we set up on Wednesday. And then we're also going to come back and look at the two paper trades that we did in the USO and also in Charles Schwab. The theme of the week was long calls. So we looked at buying an out of the money call, and we looked at buying an in the money call. One more for speculation on the out of the money situation, one more for investing, or a little less speculation, I guess, on Charles Schwab via an in the money call option. All right. So before we get too far in that, I found something interesting this week that actually was put out by Yahoo Finance. And I want to go to the screen and show you this little chart that was set up inside Yahoo Finance. Now, I want to give them credit for it. And you see that this is a Yahoo Finance chart. And the title basically sums up what that little snippet was about. VIX seasonality spells trouble ahead for stocks. Now, that's strong words in general. And one thing that I don't like much about the chart, and they didn't really mention it, is I don't know the time period. I'm guessing this is taking many different charts going back 20 to 25 years and looking at what did the VIX usually, where's the VIX usually at in January, where is it at in March, June, July, August, and then obviously September and October, which most people that trade option contracts know that September and October have historically been some of the most volatile months in the marketplace. And it has to do a lot with just if we've had crashes in the market, like big downturn, big moves, they always have a tendency to happen in September and October. No rationale behind it. No economist can come up with a reason why. It just seems to happen in those months. And hence that drives up volatility. Now, you'd be surprised to note, and I was a little bit surprised by this when I saw this chart, was that also in February and March, we usually get some big spike ups in the VIX. And now I'm going to highlight that because I want to look at a current chart of the VIX and kind of share my thoughts with you on what's going on currently in the marketplace and what the VIX has done previously in 2023. So I pulled up a chart. I went back. This is a 220-day chart. So we're going back to basically the beginning of the year. And we see here, this is January of 2023. This was 1/20/2023 right here. And I just made it a line chart. Ignore the moving averages. They don't really help us or affect us here. But if you see, if we get into March, right in this area, once again, we see that spike up. Now, this is the true VIX. This isn't a combination of many different years, but this year we're seeing some similarities that we see in the seasonality of the VIX chart that was highlighted by Yahoo Finance. And if you see this here, so here's the beginning of March, we had to run up to 26, 27, and we stayed there for a while. There looks like almost 20 days where we were in the 25, 26 range. And then just like this chart over here, I'm going to highlight now on the Yahoo chart, we see once again a drop off all the way down to the lows in July. And guess what? We're all the way down the lows. So the VIX, and I even kind of mentioned this, and I'm going to go all right here. When the VIX was at $12, we talked a little bit about this over on Options Insider Radio. I did a show where I was a guest speaker with Mark Longo and just kind of talked about it doesn't really make sense that the VIX would come down so far, so fast. And, you're trading at that 12 handle. It just means that there was just so much complacency in the marketplace. And it was kind of highlighting, the market's feeling good about the bull market. And we've had a really strong run since that downturn in the VIX. Now we just recently had the spike up, and which I find is interesting. Yahoo highlighted here, we are here. That was actually August 1st. And we got the news that the U.S. debt was downgraded, and that came on August 1st. And hence, we already had a big spike up in the VIX. So I just find it so interesting to see the similarities. Now, this doesn't mean that the bull run is over. In September, we're through earnings for the most part. NVIDIA is still out of the Magnificent Seven. NVIDIA still has to announce earnings, which will be a very interesting event by itself. But most of the companies in the S&P 500 index have announced earnings, and all the FANG stocks have. And once again, if you go to the new name, the Magnificent Seven, NVIDIA is in there, and that company still hasn't announced earnings. So we got some semiconductor stocks that are going to be announcing earnings, and they will definitely be worth watching. Okay, but September and October, we have a CPI report that's going to be coming out looking at some inflation. But until we get to the Fed meeting in September, there's really not a lot that of major news events. You can always have some geopolitical thing that can happen, obviously. Seeing oil increase a little bit. But inflation numbers could drive the market and scare the market, obviously, if they come in higher than expected. But we see these downturns in the VIX in September and October. So now this is the chart from here. So basically, this was from the beginning of the year to here. So on the seasonality, this is where we ended up at. Now, going forward, it's just kind of highlighting the fact that, guess what? September and October are volatile. Looking back 20 years plus on a chart, we see that, yeah, this is true. September and October can be volatile months. We've had a huge bull market. Once again, to go back to the Dow Jones Industrial Average, went 13 days to the positive side, almost set a new record. Needed to get to that 14 days to actually have a new record on it. So we obviously, a lot of people are saying that the markets are getting frothy because we've had such big run-ups. If that continues going into September and October, interesting time to maybe get bearish a little bit on the marketplace. And the VIX is saying that historically that has been the case. When markets go down, implied volatility goes up, and that's what we're highlighting here. Okay, now I'm going to pop back out and we're going to look at our trade. First of all, we're going to start by talking about our fun little butterfly challenge that we did. And I appreciate you participating over in my Twitter handle at Brian Overby, and participating in which underlying which magnificent stock you thought would outperform after earnings. And we got it right. Amazon was the one that outperformed. So I'm going to run to the trading account. I'm going to pull up Amazon, and Amazon is still going. Okay. On the open, and I saved this because the TradeHawk software will do this. When you first put in a trade, this is where the midpoint was at. 191 on Amazon. This was our butterfly that we set up. We came in and we looked at the expected move. We said, let's be bullish. We flipped a coin. We said, we'll be bullish on Amazon and Apple, and let's see which one outperforms. When we did that, we looked at what the long straddle was trading for on the at the money call and the at the money put. If we basically bought the at the money call and at the money put, that gives us an idea what the expected move is on the marketplace. And then we also looked at a 1 standard deviation move, and we set up our butterfly so that it could land so that if it landed somewhere between the expected move and the 1 standard deviation move, we're going to do okay on our butterfly trade. And we got almost the 1 standard deviation or the expected move on the open. It was right around $9. We came very close to that move on the open. Apple was a little bit more expensive stock, and also they were looking at about a $9 move. Now, That was to the downside on Apple, because Apple did actually disappoint a little bit on their sales on their iPhone. So the market reacted negatively. So our Apple trade is worth nothing. We put on a butterfly. We managed our risk by doing a butterfly, but we paid 70 cents for it, which was a little bit much. I really wanted it to be down around what we paid on the Amazon trade, which was right around 30 cents. But it's worth nothing now. The market went the wrong direction. Implied volatilities got sucked out of those option contracts, and there's nothing to sell. Okay. Now, right now, we see that the butterfly trade is trading at 130 on the mid. So 136 represented the expected move to the upside. 140 was right around where the one standard deviation move was. So we paid attention to the marketplace to try to set up our butterfly. And then on the high side, we're looking at 144. That would have been, well, if the market opened up and it blew away the numbers, you're looking at just less, a little bit shy of a 2 standard deviation move. And if that happened, well, we would have been very sad on the marketplace, because that would have been a huge gap opening and you wouldn't have had a time to get out. Now, we mentioned on the call, we mentioned Wednesday, that we want to get out on the open. If it ever hits anywhere close to our middle strike, we just want to get out of the trade. The butterfly maximum would be $4. We only did a 1x2x1 paper trade, and understood that you're very rarely going to get the maximum on a butterfly. And usually, if you do get the maximum, you should get the stupid award for it, because you should have been out earlier, right? You shouldn't hope that you're going to peg it perfectly and get the maximum. The risk is just not worth that reward. So we paid 31 cents for the butterfly on Amazon. When at about 10 o'clock, it was trading right at 190. So we made 6 times on our money. If you did more than one, let's say, we always look at just the simplest trade here on Options Guy TV. But if we did 5 of them, I might have sold half of the position on the open, and then let 1 or 2 of them ride, right? To see if maybe it's going to hang right around the 140, because every hour that goes by is a big deal on this butterfly, because they announced yesterday, applied volatilities are coming in, time decay is happening. The way that we can make the maximum on this trade is that we need all the time premium of the 140 to basically go away and the stock to hang out in that range. So getting the maximum in that butterfly is, I guess, the lesson today is that it's very hard to do that on almost any butterfly. So have a realistic expectation if you're going to do a trade like this. And we had the best case scenario, right? We had implied volatilities high when we put on the trade. We had 1 day remaining in the option contracts, huge theta, huge time decay. We had the move right to the 140, and we did great on the trade, right? On the paper trade, it was up 6 times what we paid for it, even more than 6 times. 6 times at 31 cents would have been 180. We sold it. We could have sold it at 10 o'clock for right around 190. That would have been a midpoint fill. Still doing great. Market has moved up more. So the more that it goes up, the more that it's going to hurt this position. But it's still trading at 120. That's, triple or quadruple what we paid for it at that point in time. So still a solid trade. And now I want to go and actually look at the what if graph on this butterfly on Amazon. So we learned a lot today. So if you put this trade on, this is the butterfly trade. This is a profit and loss calculator. TradeHawk likes to call it a what if calculator. What if this stock goes here and it happens within this time frame? I like the name what if. I think it makes a lot of sense. And right now we see the last trade, this is a live market, is moving at 143. So we're right over here in this range. Here is our profit and loss graph down below. It is not curved at all because it's only got 1 day remaining to expiration. But if you do this trade, your break evens are 136 plus the debit paid. So we'll call it 136.31. And this one on 144 is 144 minus the debit paid. So we'll call it 143.70. All right, or 69 if you want to get specific about it. So we want to stay within that range. Anywhere within that range, if we wrote it all the way to expiration, is going to be a winner on this trade. It hit right here. The maximum you could have made was $4. We were able to get half of that, close to 190. So when it gets to that point, the way you set up this trade, you just want to get out of it. That's simple. I guess that's the moral of the story. I don't need to beat a dead horse. All right. So if we move on and we look at what happened with Amazon or Apple, I'm sorry, Apple is now down $5.70. Not quite the expected move. It's about 3% to the downside. And I do want to highlight that we said we would probably put these trades on Thursday before the earnings announcement, not on Wednesday, but we do Options Guy TV on Wednesday at 11 o'clock. So that we might have adjusted the numbers a little bit, but the stocks didn't really move that much on Thursday going into that trade. Okay, so just to show you that the Apple trade is worth nothing that we put on. So the clear winner was Amazon, but on the Apple trade, I think we were like, I forgot what the number was. 185 is where the market's at. Maybe around, well, bottom line is anything above 190 is worthless, right? These are one-day option contracts. They're all done. Whatever strike that we started at, I could look at my chain, but I don't want to have to do that. So with that said, it's worthless. You're not going to get anything for it. And even on the open, it would have been hard to even try to capture a dime for selling out of that butterfly on Apple. Okay, so pause, take a breath, and let's look at our other paper trades. Our theme this week was a long call. So we wanted to set up and find underlyings where maybe I might want to do an in-the-money long call, and we chose Charles Schwab in order to do that. And then we also looked at a setup where we might want to do an out-of-the-money long call. Both of these were kind of looking for a little bit of a breakout on these underlying stocks. And on one of them, we got the breakout. On the USO and on the oil contract, it did happen. And on the Charles Schwab position, it's just hanging out, right? It's just right where it was at. So I'll start on the chart and we'll look at Charles Schwab here. So let me switch over to this. And on Schwab, let's change up the days to expiration. We're going to go to 800 just so that it's a little bit, so we can see the 200-day moving average in that. So we need a few more days to add that. And right around 66, we had a lot going on. So here's the 200-day moving average. Highlighted that we had a golden cross here where the 20-day crossed over the 50-day. We're approaching that in this underlying stock right here at this level. This was a Fibonacci number from this spot all the way down to here, right at 166 was the 50% retracement. I think it was when we put that together. This one got moved from up here, but it was from here on down. The 50% retracement was right there. So we just had a lot going on right around that 66 level. We didn't officially have the breakout, but we had a couple of gaps that needed to fill. And let me actually switch this back to candles so I can highlight these gaps. These are a couple of days in a row and a couple of candles. So just a ton of stuff going on right at that 66 level. So we just bought an in the money call option as opposed to buying the stock. We bought a surrogate for owning the stock, bought a heavy option contract in that it had a delta of around 82, which meant that if the underlying stock went up 1, we would expect our option contract to go up about 82 cents. And we're just kind of, stock hasn't done anything. There's nothing to really do with the adjustment. We're going all the way out into January of next year. And so we just are going to stay the course right now when we look at Charles Schwab. And I notice over here that we actually have a comment. We have a question. And if you have any questions, please put them in the comment box. If they're pertinent to the show, we'll definitely try to answer them. during the show. We want to make this as interactive as possible here on Option Guide TV. So let me go and check out this question that we have. There you go. It's up on the screen. Would you consider selling a call on your Schwab position at this stage? That is a good question. If we did the call option inside the options playbook, what we'd call that is a fig leaf. And that's an alternative to a covered call position when we were looking at that. So on the fig leaf, what you're doing is you're long the call option, just like you might be long 100 shares of stock. And you want to try to hedge your position or bring in some income because you're not expecting a lot of volatility here in the short term. So you'd go out and sell a call against it. And I don't mind this time period because all of the financials the major financials have all announced earnings. So volatility is coming off a little bit. I don't like being in that position when there's a major news event that's coming out because you're capping your upside by selling a call and you still have all the downside risk. So if the news is good, well, that's great. But if not, you really can pay for it with a gap opening to the downside. So at this moment, because we're still kind of waiting for that breakout that we highlighted in the chart here just a second ago, because we're still kind of waiting for that, I don't think I would do the call position. We still got a gap that we want to fill in the chart. I would want the stock to get somewhere closer to the 70 range. And even maybe 74. I'm just taking a quick peek on the chart on my other screen before I would consider selling a call against the position. But I don't mind that trade because we're going all the way out to January, and it all depends upon when we get to those levels. But the fig leaf, which is also known as a leverage covered call, kind of goes along with the fact that you're buying a stock, you're not paying all the cash for it. You're buying something that acts a lot like the stock, and you're selling a call. And a brokerage firm is going to consider that a covered position. But I always like to say you're kind of covered. Why? Because you don't own the stock. And if you get called away, you got to do something with your long option position in order to deliver that stock. So hence the name, the fig leaf. If you run over to optionsplaybook.com and you look up fig leaf, you can see a little bit more why we named it that. And the name has kind of taken off. But it's a strategy that a lot of people like to do. Just buying it deep in the money options on liquid underlyings is a very popular strategy to do in general as an alternative to buying the stock. So it would make sense that one of the most popular option strategies out there is to sell a call on a stock that you own, a covered call position. Why not do the same type of concept if you're long a deep in the money call option? Okay, so we have one more. Let's run back to the screen and let's look at USO and let's look at the USO chart. So I'm going to pull that up and we'll see. We mentioned right here, this area on the chart, 72.53. We looked at the chart on the futures contracts in oil. And if anything, we in the Yahoo futures contracts chart, we saw a very solid breakout in the oil price. Came down a little bit, got a little bit nervous when the markets were going down because of the downgrade of the US debt, which to me was just kind of silly. We're still we have a lot of debt, but we're still the currency that we trade all the commodities in. And I really don't think anybody's expecting the U.S. to ever default on their debt, but they downgraded it. Markets tanked. Oil came down a little bit, but now we've already had a rebound, and we're already having a rebound in the marketplace too. VIX ran up to 16. It's back down a little bit. It's trading at 1485. Got the Dow up a little bit, and we got Google up. Or I'm sorry, we got the NASDAQ up. I guess Google could be in the NASDAQ, but we got the NASDAQ up about 0.75 of a point. Okay, so there's that breakout. That's what we were kind of looking for. So we got a solid move to the upside on USO, and right around here. So to take that question from Schwab and talk about USO, our trade was the 75, and I'll pull up the chain here. Oops. Of course, I clicked on that. There it goes. Okay. So on the USO, we were looking at the September, we started with a 44-day option contract, and we looked at the 75 strike call. So let me clear this out. And we paid about 114 for it, and we're already up almost 75 cents. Yeah, 75 cents. Let's call it 75 cents. And so we had a solid move to the upside. If I got up, my just general numbers, if you usually double on a position, you want to consider getting out. So if I did double on this position, I did the 75, right? Yep, 98. So let's hit the midpoint and put it right there. If you could just literally sell it at that time. In Charles Schwab, I would consider staying around. Why? Because we bought a longer term option. We were doing it because we were longer term, more positive on the financials. And one of the things has happened that we want to see happen, and that the spread between the 2-year treasury and the 10-year treasury is kind of starting to come in. And ideally, with the financials, one of the things that you want is that yield curve to be more favorable. You'd like it, like the 10-year, to eventually have a higher interest rate than the 2-year, and ultimately, probably come back. I mean, 99% chance. I can't say 100%. I always got to be cautious with my words, but eventually, you would think that curve would be favorable again for the banks. It's part of the reason why we're looking at this trade. I don't expect it to happen in the short term, but as it becomes lesser and lesser difference between the two, the better off the financial and the banks just in general will do. Okay, so I'm here. What's my alternative? Stock gets up. I'm going to just take one last peek on the chart. We get next to this high right here, right around 77. So I'd say even in the 76 level, I'd think about maybe selling the call against that. Maybe I do it. If not, I'm just going to sell it and get out. So ideally, I would sell it and get out. But we talked here on Options Guy TV a couple of times about if you're buying long out of the money option contracts and the market starts going with you, one of your biggest battles is that you have to battle time decay. So if you get the run up and you think that it's going to continue, but you're worried about time decay settling in, well, then in that situation, you want to sell something against it. Give yourself some more upside. Take some of the money off the table. And ideally, you're going to sell an option contract that'll pay for the option that you bought. So you don't have any more risk on that table. So right now, I would stay the course. I like what has happened with oil. I like the little bit of a breakout that we had. We see some resistance in the USO, but the actual oil futures chart looks better than the USO chart does. And hopefully you get a little bit more upside on it. All right. Right at time. Oh, I do see another question on the fig leaf. And I'll answer that. And this will be our last question for the day. And that'll end this week of Options Guide TV. How do you calculate your break-even point on a fig leaf? Okay. So it's very straightforward. Well, on a fig leaf, it's different than on a long. I was going to give you how I calculate it on a long option contract. And on the long option contract on Charles Schwab, all you do is you take the strike price that you bought and you add the debit that you paid for that option contract. So it's very simple. Debit you paid for the long call and plus the strike price, and that gives you the break even. Now, on the fig leaf, if you want to calculate your cost basis, you then subtract whatever you sold the call for. So if I put that position on and let's say I brought in $1 for the call, I take the option that I paid, $15, and I subtract that dollar from it. And that is going to be my break even on that position. Now it gets more convoluted if I keep selling calls against my long option contract. But if you want to keep up with it, that is the one way that you would follow the trade. And inside the TradeHawk software, if you go into strategies, it'll do that for you. It will help you keep your cost basis on a position like a fig leaf and know exactly where you own it at. A lot of times, if I'm selling calls against my position, I'll go into my position screen and remind myself, on this date, I sold this call for $1. On this date, I sold it for $1. This day, I sold it for $1. On this day, I rolled it and I brought in this. And I'll just take little notes that go right along with my position. Always do that, especially on a longer term position like we're talking about here on Charles Schwab. So that's simple. Strike price plus the premium paid minus the premium received for selling the call option. That's it for this edition of Options Guy TV. We'll be back this Monday at 11 a.m. Eastern time for the next edition of Options Guy TV. Please click subscribe, ring the bell, pound that thumbs up, and we'll see you this coming up Monday for the next edition of Options Guy TV. Thanks for coming, everyone.